In October of 2011, the United States Treasury sent a certified letter to a post office box in Gideon County, Nebraska. The letter contained a notice of deficiency, Form CP3219A, informing Elias Thorne, age 87, that he owed the Internal Revenue Service a total of $140,217.34 in back taxes, penalties, and interest. The entire penalty, which had been calculated by a software system running on a server farm in Martinsburg, West Virginia, was later nullified by a single piece of paper filed on April 11, 1969, a Schedule F from the 1968 tax year. The paper had been stored for 42 years in a manila folder inside an oak roll-top desk that smelled of linseed oil and thyme. Let me tell you about that desk, because it's where the story really begins. It wasn't bought, it was built. Elias's grandfather, a German immigrant named Friedrich Thorne, built it in the winter of 1898 from an oak tree that fell on their original 160-acre homestead during a lightning storm. Friedrich was a farmer, not a cabinet maker, so the desk was not elegant. It was heavy, functional, and overbuilt. The joints were mortise and tenon held with oak pegs he carved by hand. The roll top was a series of slats glued to a canvas backing, and it made a sound like a slow wooden waterfall when you closed it. Friedrich built it for one purpose: to keep the records. For him, the land was one ledger and the desk was the other. You tended to both with the same seriousness. In one of the desk's 24 cubbyholes, he kept the original deed signed by President Grover Cleveland's administration under the Homestead Act. In another, he kept seed packets from each year's harvest, and in the main drawer, he kept the financial ledgers. When Elias's father, Marcus, took over the farm in 1932, the worst year of the Dust Bowl, he inherited the desk and the practice. The farm nearly failed 3 times in that decade. The creek dried up, the topsoil blew into Kansas, and the bank in town closed its doors, taking the family's $412 in savings with it. But Marcus kept the records. He noted the cost of every bag of feed, the price of every bushel of corn sold, the exact date the new well pump was installed, and how much he paid the man who installed it, $18.50. He did this not because he was a trained bookkeeper, but because his father had told him, "The land remembers everything, and the books must remember too. The numbers tell a story, and if you don't write it down, you forget the story. And a man who forgets that story will lose the land." Elias Thorne inherited the farm, the desk, and the story in 1958. He was 34 years old, had served in Korea, and was known for his quiet demeanor and his unusually steady hands. He could fix a combine engine with a crescent wrench and a piece of wire, and he could tell you the moisture content of a corn kernel by feeling it between his thumb and forefinger. He expanded the farm, buying an adjacent 160 acres in 1964 for $300 an acre, a price his neighbors thought was extravagant. He grew corn and soybeans, and for a period in the 1970s, he raised Hereford cattle. Some years he made a significant profit. In 1973, during the Russian grain deal, he sold his corn harvest for a net profit of $48,000, which was more money than his father had seen in his entire lifetime. Other years, he lost money. In the farm crisis of the 1980s, he lost $19,000 in 1982 alone. The interest rate on his operating loan hit 18.2%. His neighbor, a man named Dave Jensen, lost his farm to the bank. Elias watched from his kitchen window as the auctioneers sold off Jensen's equipment, piece by piece. That night, he sat at the old oak desk and wrote in his ledger, in neat, blocky handwriting, the details of the auction. Not just the prices, but the look on Dave Jensen's face. The story had to be complete. Through all of this, for 53 years, Elias prepared his own taxes. He did it at the oak desk, usually in the first week of April. He used a pencil and a large tabletop calculator. He filled out the Form 1040 and,
Most importantly, the Schedule F, profit or loss from farming. He kept every receipt, every invoice, every bill of sale. He filed them by year in grey metal filing cabinets that stood against the wall of his small office. And in the bottom right drawer of the oak desk, in a folder labelled simply Tax, Permanent, he kept copies of every single tax return he had ever filed since 1958. This brings us to Mr. Robert Davies of the Internal Revenue Service. Davies was 34 years old, the same age Elias had been when he took over the farm. He had a degree in accounting from the University of Nebraska-Lincoln and had worked for the IRS for 6 years. He was not a villain. He was a product of a different system, a different kind of knowledge. He believed in data, in algorithms, in the objective truth of numbers processed by a computer. His world was one of spreadsheets and statistical analysis. He had never set foot on a working farm. His job, in the small business/self-employed division, was to review files flagged by the automated underreporter program. The computer, in its impartial wisdom, had flagged Elias Thorne. The reason was simple. For the tax years 2008, 2009, and 2010, Elias Thorne had reported significant losses on his Schedule F. In 2008, the commodity markets had crashed, and his operating costs exceeded his revenue by $31,000. In 2009, a hailstorm in July had wiped out 70% of his soybean crop, leading to a loss of $42,000. In 2010, a drought had reduced his corn yield by half, resulting in another loss of $28,000. For 3 consecutive years, the farm had not turned a profit. To the IRS computer, this pattern was a red flag.
It triggered an audit based on Section 183 of the Internal Revenue Code, the so-called hobby loss rule. This rule is designed to prevent wealthy individuals from using, for example, a horse farm or a vineyard as a tax shelter, deducting its losses against their other income. To be considered a business, an activity must be engaged in for profit. If the IRS determines your activity is a hobby, not a business, you can't deduct your expenses. The computer, looking at 3 straight years of losses from an 87-year-old man, made a logical inference. This was no longer a business. It was a hobby. So Mr. Davies was assigned the case. He sent the initial audit letter. Elias responded, as requested, by mailing copies of his meticulous records for those 3 years. Davies ran the numbers. The records were perfect. Every expense was documented. Every piece of income was reported. But that wasn't the point. The point was the motive. Was this a business, or was it the hobby of an old man who enjoyed playing farmer? Davies looked at the file. Elias Thorne was 87. He was collecting Social Security. He had a small pension from a seed cooperative. The farm was his home. In Davies's mind, the picture was clear. The man wasn't farming to make money anymore. He was farming because it's what he had always done. It was his life, his home, his hobby. Following IRS procedure, Davies made the determination. He reclassified the Thorne farm as a hobby activity for 2008, 2009, and 2010. He disallowed all the farm expenses Elias had claimed, which totaled over $300,000 for the 3 years. This resulted in a massive increase in taxable income. On that new income, Davies's software calculated the tax owed, plus penalties for substantial understatement, plus interest compounded daily. The final number was $140,217.34. He printed the notice, signed it, and had it sent via certified mail. In his mind, it was a routine case. Closed. Elias received the notice on a Tuesday. His grandson Samuel was there. Samuel was 25, a recent college graduate who worked a marketing job in Omaha, 200 miles away. He loved his grandfather, but he viewed the farm as a relic, a place of sentiment, not commerce. He had been gently encouraging Elias to retire for years, sell the land to the big corporate farm next door, take the money, and enjoy his last years. Samuel saw the envelope, saw the IRS return address, and opened it. He read the number, $140,217.34, and his face went pale. He thought it was a mistake, a typo. He read the explanation. Hobby loss rule, disallowed expenses. He looked at his grandfather, who was sitting at the kitchen table, calmly drinking a cup of coffee. Grandpa, this is insane. They're saying the farm is a hobby? They want $140,000. We have to fight this. We have to get a lawyer, an accountant. Elias took the notice and read it slowly. He didn't seem angry or scared. He just seemed thoughtful.
He folded the letter and put it in his shirt pocket. He said, "A hobby. They think after 80 years of this, it's a hobby." Samuel spent the next week frantically calling tax attorneys and CPAs in Omaha. The first CPA he spoke to charged a $500 consultation fee. He looked at the notices and shook his head. "This is tough," he said. 3 years of losses at his age. The presumption is against you. We can argue it, show his history, his work ethic, but it's an uphill battle. It will cost you $10,000, maybe $15,000 in fees just to take it to tax court, and the chances are 50-50 at best. The lawyer said much the same thing. The IRS has a strong case here. The burden of proof is on you to show a profit motive. Given his age and the recent loss history, that's a very high bar to clear. He quoted a $20,000 retainer. Samuel came back to the farm that weekend, defeated. He sat at the kitchen table and laid out the options. "We can fight it," he said, "and it will cost a fortune, and we'll probably lose.
We can try to negotiate a settlement, an offer in compromise, but they'll still take a huge chunk. Or we can sell a piece of the land to pay it. That big corporate farm, AgriCorp, they'd pay cash for 80 acres tomorrow. It would cover the bill." Elias listened patiently. He looked out the window and the fields, which were turning the color of straw in the autumn light. He had heard the arguments from the experts, the confident outsiders who knew the system, and their logic was sound within the confines of the world they knew. Their world was the present. It was the last 3 years of data. It was the current interpretation of Section 183. But Elias's world was different. His world stretched back to a lightning storm in 1898. He stood up and walked into the small office. Samuel followed him. Elias went to the old oak desk. He didn't pull out the recent ledgers. He didn't pull out the records from 2008 or 2009. He ran his hand over the roll top, the wood worn smooth by 3 generations of thorns. He knelt down with the slow, deliberate movement of an old man and opened the bottom right drawer. The drawer made a slight groaning sound. Inside were dozens of manila folders, their tabs brittle with age. The labels were written in his father's cursive and his own block printing. He ran his finger along the tabs. 1962, 1963, 1964. He went past the 70s and into the 60s. His fingers stopped on a folder. The tab read 1968. He pulled the folder out. It was thin. Inside was a carbon copy of his Form 1040 from that year, the paper yellowed and fragile. Attached to it was the Schedule F. He took the form out and laid it on the desk. Samuel looked at it, bewildered. "Grandpa, what is that? That's from 40 years ago. What does that have to do with anything?" Elias didn't answer. He just pointed a finger, its nail thick and ridged with age, at a specific section of the form. It was a small box with a line next to it. Let me tell you about that line, because in 1968, it was a minor, almost trivial part of the tax code. But time has a way of turning small things into big things.
The history of the hobby loss rule is the history of a changing America. Before the 1960s, the rule was vague. As long as you had a reasonable expectation of profit, you could deduct your farm losses. But in the 60s, a lot of city doctors, lawyers, and businessmen were buying up farms, not to work them, but to use their inevitable losses to offset the high taxes on their professional incomes. The Kennedy and Johnson administrations saw this as a loophole for the rich, so Congress decided to tighten the rules. The result was the Tax Reform Act of 1969. This law created the modern Section 183, the one Mr. Davies was using against Elias. It established a set of 9 factors to determine profit motive, and it created a new, harder standard.
It also created a presumption. If you made a profit in 2 out of 5 consecutive years, the IRS would presume you were a business. If you didn't, the burden of proof was on you. This is the rule everyone knows today. But Congress was worried about hurting actual, legitimate farmers who might have a few bad years in a row. They knew farming was cyclical. So they included a transitional provision. It was a one-time offer. For tax years beginning before 1970, a farmer could make a special election. This election basically said, I want to be judged under the old, more lenient, reasonable expectation of profit rule for the rest of my life, as long as I continuously operate this same farm. But there was a catch. To make the election, you had to agree to postpone the statute of limitations. You were giving the IRS the permanent right to come back and challenge any of your lost years at any time in the future if you didn't eventually show a profit. It was a gamble. Most farmers and their accountants didn't even know about it. It was a dense little piece of tax code buried deep in the new law. But Elias Thorne did not have an accountant. He had the IRS instruction booklet, a pencil, and a pot of coffee. He sat at his oak desk in the spring of 1969, reading the new rules. He read about the 2 out of 5 years presumption, and he thought about the Dust Bowl years his father had endured. There were times when his father didn't make a profit for 7 years straight. He thought, 2 out of 5 is a fair weather rule. A farm needs a rule that understands drought. So he found the transitional provision. He understood the gamble. He was betting that his farm, over the long arc of time, was a profitable enterprise. He was so confident in the long-term viability of what his grandfather had started that he was willing to let the IRS look over his shoulder forever. He took his pencil and on his 1968 Schedule F on the line designated for such elections, he checked the box. He made a copy for the folder and mailed the original. Then, for the next 42 years, he just kept farming. The world changed. The tax code was rewritten a dozen times, but that one-time election made on a piece of paper in 1969 remained in force. It was grandfathered in, a permanent covenant between him and the government. Of course, the IRS of 2011 had no memory of this. Their computer systems were not designed to look for a 42-year-old paper election. The institutional memory was gone. The system only knew the modern Section 183. It only knew the 2 out of 5 rule. Mr. Davies, for all his training, had never once in his entire career encountered this provision. It was an artifact of a forgotten world. Elias looked at his grandson. He said, "We are not hiring a lawyer. We are not selling the land. You will drive me to the IRS office in Lincoln next Wednesday. You will make an appointment with Mr. Robert Davies." The IRS office in Lincoln was a soulless place. Grey carpet, grey cubicles, fluorescent lights that hummed with a weary buzz. Samuel felt a knot of dread in his stomach. He was walking his 87-year-old grandfather into the lion's den with nothing but a piece of antique paper. He felt foolish and terrified for his grandfather. They were led to a small, windowless conference room. A few minutes later, Mr. Davies came in.
He was wearing a cheap suit and a polite professional smile. He carried a thick file folder with Thorne, Elias on the tab. He looked like a man who was just doing his job, a job he believed in. Mr. Thorne, Samuel, thank you for coming in, Davies began. I've reviewed the file, and while I appreciate your grandfather's long history of farming, the law is quite clear on this. 3 consecutive years of substantial losses create a strong presumption that the activity is not engaged in for profit.
Samuel started to speak, to argue, to bring up the hailstorm and the drought.
But Elias put a hand on his arm, gently but firmly. Elias looked at Mr. Davies. He did not raise his voice. He did not sound angry. He spoke with the simple, matter-of-fact authority of a man who knows his ground. Mr. Davies, he said, you are using the wrong rule. Davies's smile tightened slightly. Sir, I can assure you, Section 183 is the correct part of the Internal Revenue Code. I have handled hundreds of cases like this. Elias said nothing. He reached into a worn leather satchel, the one he used to carry his lunch to the field, and pulled out the manila folder from 1968. He opened it and slid the yellowed Schedule F across the table. The paper was so old it was almost translucent in the harsh office light. I made an election, Elias said, in 1969 for the 1968 tax year, under the transitional rule of the Tax Reform Act of 1969. My farm is not subject to the 9 factors or the 2 out of 5 years test.
It is subject to the reasonable expectation of profit standard that was in effect in 1969. Davy stared at the paper. He had never seen a form this old. He picked it up. The texture was wrong. The font was from a typewriter. He read the words. He saw the checked box. He saw the reference to the public law that enacted the 1969 reforms. A flicker of uncertainty crossed his face for the first time. This is highly unusual, he said. I've never seen one of these. I'm not sure it's even still valid. I'll have to look into it. Elias nodded. You do that. He then reached back into his satchel and pulled out another folder. This one was thicker. He opened it and laid the contents on the table. They were the summary pages of his Schedule F filings for every year from 1958 to 2010. 53 years of farming reduced to 53 pages of numbers. And while you're looking into it, he continued, you can review these. This is the story of my business. You will see 29 profitable years and 24 losing years. You will see that over the course of 53 years, this farm has generated a cumulative net profit of $417,822. If that is not a reasonable expectation of profit, then you tell me what is. Davies was silent. He looked at the stack of old tax forms. He looked at the 1968 Schedule F. He looked at the old man across the table, whose eyes were clear and steady. The entire edifice of Davies's case, built on an algorithm and a 3-year snapshot of data, was crumbling in the face of a lifetime of evidence delivered on paper. The confident outsider was facing a quiet expert, and the expert's knowledge was deeper. It was rooted in time. Davies stood up. I need to consult with our legal counsel. We will be in touch. He took the 1968 form and left the room. Elias and Samuel sat in silence for 10 minutes. Then a different woman, older, with a severe look, came into the room. She was the chief counsel for the regional office. She held the 1968 form in her hand as if it were a Dead Sea Scroll. She looked at Elias. She didn't sit down. Mr. Thorne, she said, we have verified your election. It is valid. All penalties and proposed taxes are abated, effective immediately. We apologize for the error. You will receive a formal letter of confirmation within 30 days. She turned and walked out. It was over. A single number announced, the climax delivered in a quiet, airless room.
The contrast between the months of anxiety and the brief bureaucratic surrender was stunning. On the 200-mile drive back to the farm, Samuel was quiet. He kept looking over at his grandfather, who seemed unchanged by the victory. He just watched the fields go by. Finally, Samuel spoke. "How did you know? How did you even remember a form from 40 years ago?" Elias thought for a moment. "I didn't have to remember," he said. "The desk remembered. You write the story down, you see. You write it all down, not just for the government.
You write it for yourself, so you don't forget who you are."
They drove the rest of the way in a comfortable silence. Let me tell you what happened after that. Mr. Davies was not fired, but the Thorne case became a cautionary tale in the Lincoln office, a story whispered to new agents about the limits of computer-generated audits. Davies himself requested a transfer to a different department a year later. He never wanted to be proven so completely and fundamentally wrong again. The system he believed in had a blind spot, and the blind spot was history. The formal letter from the IRS arrived 2 weeks later. It was a single page stating that the audit was closed and the balance due was $0. Elias pinned it to the corkboard in his office next to a calendar from the local feed store. The most significant change was in Samuel. He had witnessed a battle not of dollars and cents, but of two entirely different worldviews.
His world of digital immediacy and short-term data had been defeated by his grandfather's world of analog permanence and long-term perspective. He saw that the farm was not a relic. It was an archive. It was a living repository of knowledge. He started spending every weekend at the farm. He didn't talk about selling the land anymore. He asked Elias to teach him about the books. He sat at the old oak desk, the one built from the fallen tree, and he learned the story. He learned how to read the land, and he learned how to read the ledgers. He understood that they were the same thing. Elias Thorne passed away 2 years later in his sleep at the age of 89. He died in the same house he was born in. He left the farm, all 320 acres, the house and the oak desk, to Samuel. There was no mortgage. The farm was free and clear. Samuel runs the farm now. He uses a laptop and accounting software, but once a year, in the first week of April, he sits at the old oak desk. He prints out a paper copy of his tax return. He files a copy of it in the grey metal cabinets, and he keeps the permanent documents, the ones that tell the long story, in the bottom right drawer. He is adding his chapter to the story, ensuring the desk will remember. What survives is not always what is newest or most efficient. Sometimes what survives is what has the deepest roots. The IRS, with its powerful computers and its thousands of pages of regulations, is a system designed to look at the present. It has a very short memory. The Thorne farm, embodied by an oak desk and a set of paper ledgers, is a system designed for the long haul. It has a very long memory. And in this quiet confrontation, the long memory won. It wasn't about the money. It was about a principle. It was about what endures. It wasn't a victory of a man against the government. It was a victory of patience over haste, of depth over shallowness, of a story over a statistic. And that is what matters.